So today, as through last night, the ag is up about 2.5% year to date. Corporates are up about 3%. I talked about this before, but if you're buying into the ag, if you're buying into a core fund right now, you're taking on the exact same risk, if not more risk, as you were a year ago. Your yields are higher, but you are still very, very long duration, and you're going to be long duration for a long time. And if we're heading into a recession, okay, we should see some widening out. We should see some underperformance relative to treasuries. Okay. So we look at this screen every day. This is PX1 on Bloomberg. This is T-bills. T-bills are a great place to hang out. You go a little bit further out the curve though, and you're only getting, 4.8 down to about 3.8. 10 years at about 3.8 today. Okay. If we look at the curve since the start of the year, everything 5-year and out is basically the same. But the front end of the curve, obviously the Fed has continued to raise rates in the first couple meetings. They just stopped. But they're telling us they're going to raise another 2 times at least between now and the end of the year. Okay. So again, a lot of financial advisors and allocators out there are advocating for T-bills. Okay. If you're invested in T-bills right now with this shape of the curve, what you're doing is you're really setting yourself up to currently yield 5, but go down to 3 real quick. Okay. And we'll get to that in a second. I want to go through this curve right here. This is really important. I'm going to move this agency bond over to here. So this is the forward-looking SOFR curve 2 years ago. This is June 22nd of 2021. Out 10 years, the curve starts at 0.04%. Out 10 years, the market was saying that rates were never going to get higher than 1.75%. Okay. You could take the over on that. You could say, you know what? I'm going to buy a floater that if rates do go to 3 or 4 or 5%, I'm going to benefit from that. And my prices are actually going to go up on my securities. But like SVB or the government or a lot of banks out there, they only buy fixed rate paper. So at that time, in relatively safe fixed rate paper, your best option was maybe investing at 2% yield. Okay. Here's where that curve is today. And this is forward sloping. Okay. Upward sloping, which is normal. This is not normal. I call this a violently inverted short curve. Okay. We go up to about 550, 540, and then we go down real quick to about 3%. Okay. So what the curve is telling, if you're investing in T-bills right now, what you're saying is like, okay, I'm going to own this at 5, but I know that my yields are going to quickly go down to 3. Okay. So you have a couple of options to combat that. One of which is, oh, I'm just going to go longer duration. I'm going to buy a 5-year or a 7-year bond. Well, the problem with that is if you own, let's say, a 7-year or a 5-year treasury, okay, let's say you own the 5-year at, and let me bring up my table here. Let's say you own the 5-year at 4%, okay, and you go to it and you owed that for 3 years. Well, that yield's actually going to go up. It's going to go from 4. You're going to roll up the curve. Usually you roll down the curve in a normal curve. Here you're going to roll up the curve. So over the next year, let's just say you go from 4 to 4.3 in a year, and you multiply that times your 5-year duration, you're actually going to have a 1.5% loss. Okay. So you're going to make that 4% coupon, but you're going to give back roughly 1.5 points in terms of underperformance, i.e. unrealized losses.